Stocks are down this morning, even as the greenback is lower by 0.5%. Not something you typically see when investors are used to buying equities when the dollar's down. We do have bonds selling off, so rates are up this morning. Let's get into some of the reasoning for why with Chance Finucane. He's the Chief Investment Officer at Oxbow Advisors. Chance, welcome back to the show.
Hi, Oliver. Thanks for having me back.
Sure thing. Tell me about how you're viewing the world and the central bank trade-off right now in particular. Our Fed here tried to kind of go on cruise control. Markets may be telling them the last couple of weeks they can't do that yet. But at the same time, we've got a little bit more aggression from the ECB, and Chinese data's coming back.
There are some contrasts. I think with the way the world is so global, you do have to pay attention to all of the central banks and what they're doing. So even though you have the U.S. and the European central banks being more hawkish and trying to tighten, since October, you actually had the Japanese and Chinese central banks starting to ease even further. And that's actually been a stronger effect than the tightening in Europe and here in the U.S. So that's actually, we think, had a little bit of an effect on the market rally over the last 4 months. But with where prices are at today, we would still have a defensive posture. We've actually been leaning even more defensively in the last month with this recent cyclical rally, with some of these sectors having gotten to prices that we think are fairly or overvalued. We're shifting back towards areas that we think are more reasonably priced and generating a lot of yield for our clients.
Are those U.S. trades? Are they international trades? Take me through it.
Right now, it's more U.S., although for a lot of these multinational companies, they may have a lot of exposure overseas. So, for instance, gold businesses, we are increasing our exposure to gold and gold-related companies in our high income and our equity strategies for our clients. And they do have a lot of exposure overseas, so that'll play a factor. And as you just mentioned, if we do start seeing any dollar weakness, that's good for those types of businesses. One thing we have noticed is that the U.S. dollar is starting to strengthen a little bit again. And given the economic weakness we would project, we think that might still be a bit of an issue for the financial markets, just because you see a lot of investors shift assets to U.S. dollar central items just to make sure that they're safer. So that might still be an issue, but we are monitoring for international opportunities. They're just not quite at the prices yet over in Europe or overseas that we would want to move in just yet.
Okay. What are you looking for? What are the signs that maybe there is a more obvious all clear on that front?
Yeah, we would think that right now you're starting to see earnings expectations come down bit by bit. But even later this year, the investors are thinking that we're going to get back to 9 to 11% earnings per share growth by the fourth quarter this year, or even into 2024. We just aren't that optimistic. We just went through our first quarter with negative earnings per share growth for the S&P 500. That's expected to continue for the first half of this year. And we think it's going to be a difficult environment for companies to turn around their profit margins when you have the Federal Reserve and the ECB continuing to push up rates. And there's really no reason for them to change that until something breaks. Historically, they want to see things slow down, and they're not getting what they want in the data yet. And they're going to continue to do that for as long as they need to. And what we're focused on is the end game, regardless of how long it takes, we think is going to be just something that we want to look for better prices and better valuations. And 17.5 times earnings on a earnings multiple that we think is too high is just not that attractive at this point.
What type of either drop in prices or pickup in the economy or growth could normalize that valuation? How do we normalize it? How do we kind of reset here? Do we need to see another big leg down in stock prices? One of the other ways, of course, is we could earn our way out into that valuation, but based on the data, it doesn't look like we've got a great chance of that right now. Earnings are coming down, and supposedly the yield curve tells us recession's on the way in a more deeper, obvious fashion.
You're right. There are numerous data points that suggest that there will be some sort of recession on the horizon over the next 12 to 18 months. What we're looking at is, let's just say you're at 17.5 times earnings right now, and let's say the earnings number is correct. Historically, the average is about 16 times, so you could easily fall another 10% just to get back down to a more normal valuation. And if you're really looking for a great opportunity, the great buying opportunities we had in 2008, 2009, 2011, the end of 2018, March of 2020, you would need to see the S&P 500 get down to about 3,200, which is about 20% lower than where it's trading today. That would be the spot that we would think, okay, now we're starting to get some opportunities that we really feel enthused about. We got about halfway there by October, but then the market turned and started moving higher. So we're just going to stay patient because this can play out over multiple years, similar to how it did in the dot-com bubble, where it was 3 years from the March 2000 high to the eventual low in March of 2003.
Is it do you envision a hard crash, or do we take step by step? I've kind of been thinking about that old phrase lately, stocks take the stairs up and the elevator down. Not sure if it makes as much sense right now. It seems like inflation is kind of a stair step thing. It's like we slow down a little bit, we deflate a little bit, and everybody says, oh, I got to go buy that home. I got to go buy that Tesla on discount. Inflation comes back. Are we going to keep doing this dance back and forth?
We think that's more likely. It's always possible that something acute happens in the economy or in the financial markets that makes stocks, like you said, take the elevator down. But this definitely looks a little bit more like the stair step that you were describing. And we see inflation getting down to maybe to just below 4% by mid-year. But what we look at in the data is it's going to stay pretty persistent around that 4% level through the rest of 2023. And that's going to create a tough spot for the Fed as to what they want to do. And if you look at nominal GDP growth, so real growth in the economy plus the inflation rate, we're headed back to a level of about 4 or 5% in nominal GDP growth, which is what we averaged through the 2010s. The problem is almost all of that growth is inflation. That's not real growth. And that's going to be a difficult environment for companies to generate profit growth. You just talked about Lowe's. Lowe's and Home Depot are great companies, but they're going to have real trouble trying to keep up their profit margins. And for the first time in over a decade, their comp sales growth is going to be negative. That's just a tough environment. And so we're monitoring companies like that, but we think they could trade a little bit cheaper before we'd want to move in.
All right. And in the meantime, when you talk with clients, I mean, does that mean there's a lot of cash on the side? I just want to come back to that main point about how it affects the decision making. Do you leave a bunch of dry powder? Or, do you look at bonds and view that as a adequate return that we're getting right now? You know, you can get 3-4%. You don't even have to go all the way out to the 10-year.
Yeah, you can get 5% in a 6-month treasury right now. And so that whole idea of there is no alternative, that doesn't apply anymore. You can get 5% risk-free and just sit and wait for a better valuation. And right now, with where currently stocks are priced at, we would say it's difficult for them to do a lot better than a 5% annual return over the next 5-10 years. You need a better entry point. So you've got short-term treasuries at a 5% yield. You have preferred stocks that are investment grade rated that are trading with a 6% yield. And then there's some other high quality defensive businesses in areas like healthcare. You're starting to see consumer staples pull back a little bit. There are some REITs that deliver 6% yields. Those are all decent areas to sit and have some of your money invested while waiting for those cyclical sectors to pull back more. And then you really get an opportunity to buy in at great valuations.
All right, great conversation, Chance. Like the specifics here on the ideas as well as the big macro themes to consider. Certainly a little bit of caution in the tone, and we'll take heed of that.
If you like this video and want to stay up to date on our views about the financial markets, please subscribe below to our Oxbow Advisors channel.